In bringing this presentation together, and I went through it over the last couple of days and went through it again last night, I realized I've been quite ambitious in the amount of content that I've put together. So we may have to go through things a little bit quickly in some areas, but I will pause in some of the others. But I do want to echo some of the things that we've heard already today, but very much focus on that value shift and how we're seeing value shift through the macroeconomy. And I always like starting there. I'll promise you I'll try not to keep it too dry. But then equally how we then see that morph into markets on the ground. And then I'll leave you with a few kind of forward-looking statements. Now, I always like to start with the macroeconomy and specifically GDP, because CRE is a lagging indicator. Where the economy goes, CRE will eventually follow. So let's have a quick look at this and unpack things. So at the base level, if you think about Australian GDP over the last 20 years or so, it's actually been pretty good. Been growing at around 2.5% per annum. It's about 2% at the moment. It is slowing a little bit, but on the whole has done quite well. So the economy, as you can see, 64% larger now than it was 20 years ago. But we need to understand what's been driving the economy. And it's fundamentally population growth. So population has grown 47% over the same period. We've gone from roughly 20 million people to where we are now. I hope everyone did your census form correctly. Highlight of my 5 years, that is, every 5 years. Love doing the census form. But it has been population-driven growth. Now, we've had full employment. We're currently at about 4.3, 4.4% unemployment rate. So we've got more people coming in. We've got jobs for them. They're demanding more goods. They're demanding more services. So therefore, the economy is growing. On the face of it, this is quite good. But at the same time, this very tight level of unemployment is causing other problems and other forces. It wasn't that long ago that full employment was considered at 5%. We got down below 4%. We've now bounced back up a little bit. Well, we're still well below what was considered full employment. So as a result of that, we've had significant upward pressure on wages. So in economic terms, nominal unit labor cost. How much does it cost to do something? And if you look at that green line, especially over the last 5 or 6 years, you can see it takes a very, very steep trajectory. So labor costs are now 72% higher than they were 20 years ago. What companies are doing are then pushing that back onto the consumer. This is why we have an inflationary problem. And if you look at the two, now inflation has grown, surprise, surprise, at about the same amount that we've seen labor costs increase. So that's why the cost of things is getting more and more and more. But if you bring that back down to the economy and bring that back down to population, GDP per capita, so output per capita, has actually only grown 20%. So bring this all together, what does it actually mean? Well, Australia's got a pretty significant productivity problem. This highlights our productivity problem. We've increased our productivity by 11% over the last 20 years. In fact, it started to go backwards over the last few years from late 21, I think it was, through to about 2020, late 2024. It's marginally ticked up. And we're not alone at this. This is Europe, grown 8%, UK, 7%. But compare that to the US, compare that to one of our Asian neighbors, Singapore, compare that to China. Had to use the right-hand axis for China. 400% growth in productivity. So if you want something to focus on in the macroeconomy over the near term, it has to be productivity. There needs to be a laser focus on that going forwards. So how does that start to translate into the office market? Back to our inflationary problem. So the dark blue line is inflation over the last 10 years, about a 30% increase. Building costs, which is the lighter blue line, increased nearly 60% over that time period. So the cost to get stuff out of the ground has gone up dramatically more than inflation itself. Now, we've done a lot of work on this over the course of this year, and we launched it all about last month or so. This is focusing specifically on the office sector. So market rent is the rent that you pay to rent a building at the moment, and these are CBD market rents. Economic rent is basically, in simple terms, the cost to build a building. So how much rent do you need to get back to build a building today? There's a bunch of other numbers in it, but in simple terms, that's the easiest way to understand it. What you can see here is that for every single CBD, the dark blue line, i.e. economic rent, is higher and at times significantly higher than the light blue line. Here in Sydney, it's actually the tightest. It's an 18% difference. Adelaide, 44% difference. My home market, Brisbane, it's a 28% difference. I should add that last year, rents in Brisbane grew 25%. It was the fastest growing market in Asia Pacific. They're still running at 18% growth year on year as of Q2. So that tells you how rapidly rents are going to have to accelerate because these input costs, these building costs are still going up. But that tells you how quickly rents are going to have to run before more buildings come out of the ground. And so, unsurprisingly, we're seeing this out in the market right now. So if you look at the the top right-hand chart, Melbourne actually has the most amount of supply coming out in the next couple of years, about 250,000 square metres. Most of that's this year. It then dries up from 27 onwards. Here in Sydney, again, dries up after 2027. I was in Perth a couple of weeks ago. Nothing is getting built in Perth at the moment. And my home market, Brisbane, you've got Dexus's Waterfront Place complex coming out of the ground. And again, that's pretty much it. So if you are out in the market and if you're looking for space, the key message here is think less supply rather than more supply. And our inflationary problem is going to mean that that's going to go on for longer. But again, I would say that we're not alone here. So new office supply under construction in Australia is down 61% from peak. If we look at the rest of Asia Pacific, the top 19 cities, and I've discounted India here, I was just in India last month, they're still building like it's going out of fashion, 180 million square foot under construction in India, in 8 cities, 180 million square foot. Sydney CBD is about 55 million square foot. Gives you a sense of scale. They still don't think that's enough space. But Asia Pacific down 53%, Europe down 40%. The US is down 86% on peak in terms of new office coming out of the ground. So if you're in global organizations, again, less supply rather than new supply, rather than more supply. So that's a bit of a whistle-stop tour to kind of what's been going on from the macroeconomy and how it's feeding through into markets on the ground. But how are we seeing value shift within markets and in kind of individual assets and local assets? Now, everyone has heard about earning the commute, and I think everyone has got their own slide or favorite pet slide around earning the commute. This is my version of it. This is using experience per square foot, which is our workplace strategy tool. And it's looking at people who don't think the commute is too long, which is the lighter blue, to those who do think the commute is too long, which is the darker blue, across 4 key productivity or workplace metrics: productivity, best work, team, and focus. And you can see in every single one of those people who think that the commute is too long are 10 to 15 percentage points lower in their reporting for any of those key metrics. At the same time, I would say that commuting and distance of commuting and views of commuting are also very, very tightly tied to well-being in the workplace. Well-being in the workplace is highly tied to productivity as well. So there are actual tangible outcomes of the commute. So you then need to look at, why do you want people to come into the office, and are you giving them what they want? Now, this data is about a year or so old, but it still illustrates the point that we know the office is there for the human interaction elements, whether it's collaboration, relationships, socializing, connection, innovation, all of those kinds of things. And based upon our data, and it's over 200,000 respondents and about 12 million data points, so it's a pretty robust data set. Just over half reckon that the office does what they need it to do. So that then prompts the question of, okay, what do we do about it? And I do have to say, this is one of my favorite quotes. I have commandeered it as my own. It isn't my own, it's from our workplace strategy team. But anyone I talk to about it, I say this is mine, because I absolutely love it. But workplace experience needs to be enticing enough for people to make the investment to visit the office and compelling enough for people to repeat and return. Absolutely love this. So it's got to be enough that they want to come in, but the reward has got to be there that they want to keep doing it again and again and again. Now, I just want to do a quick segue, and I know I'm a bit short on time here, but I just want to do a quick segue into a little bit of that, because I know you're probably going to ask me a question of, okay, well, how do you create the office that people want to come into? I'm not going to go into in extreme detail, but a few things to think about. So creating a sense of community. It's a bit like going to the gym or your yoga class or something like that. Like if you're going to meet people there that you want to interact with, that you feel part of, you're going to do it again and again. No, it needs to be energetic. You need to draw energy from the workplace. It can't suck energy from you. It's got to be easy on the eyes. Now, this isn't just about neurodivergence. Sure, the research is out there that's saying that if you've got right lighting, good wayfinding, right materials, right color schemes, that it helps on the a neurodivergent side of things. But actually, the research shows that it helps everybody as well. So huge, huge gains from there. Other key thing is around privacy. I think one thing the pandemic taught everyone was taking personal phone calls at home was very, very easy. People coming back into open work plans and having to try to take a personal call, people felt very, very awkward. So what we're now seeing is quite a lot of reuse of space. So what used to be large collaboration rooms, where everyone thought collaboration was groups of people standing around a whiteboard thinking great thoughts, it's happening a lot more organically than that. Some of those big spaces are getting repurposed into things like individual phone rooms and stuff like that. And last but by no means least, that seamless integration of technology. And that's obviously always everyone's biggest bugbear, trying to move between different offices and home and office and making that technology work. But I do just want to go back and focus on enticing enough. So we all hear about flight to quality, but I want to give you a different lens on it and maybe put a value perspective on it as well. So this is for some work that we did over the, I think, last year or so through to this year. And we came up with our own building quality index based upon the 4 S's: site, sustainability, services, and situation. So things like building location, local amenity, connectivity to public transport, floor plates, natural light, sustainability ratings, all of those kinds of things. So about 12 to 15 different variables. We then ran every prime grade building through Sydney, Melbourne, Perth, Brisbane, through our BQI. The ones on the right is for Sydney CBD, and there's a few key takeaways from this. In terms of value, premium isn't always best, certainly not in Sydney. So sure, there's a lot of gold, and they're the premium grade buildings. Each column is a building. There's a lot of gold on the right-hand side in the top 25%. But you can see that as you start to move to the middle, there's a bunch of gold there as well. So whether it's an older building, hasn't been refurbed, in a poorer location, no local amenity, or whatever. So if you are looking for high quality premises, it doesn't always mean that you have to go for premium. Second thing is, if you bring the two together, what we call the prime office market, if you look at the top 25 to the bottom 25%, you can see that there is a significant variation between the two. And last but by no means least, what this tool does allow you to do is actually compare within grades as well. Obviously, through something like the PCA, fantastic guide, you know it's an A-grade building. But how does that A-grade building compare to that A-grade building? And for those of you who are interested, we also did it for Melbourne. Here is Melbourne. You can see that it's a lot better proxy. Premium is a lot better proxy for quality due to age of building stock and a few other issues. But again, you've got that top 25 to bottom 25% divide going on. So where else are we seeing value concentrating? There's quite a lot going on in this slide, so I'll walk you through it step by step. If we think about core location, for Sydney, that would be basically from Circular Quay back to Market Street, effectively. Much higher demand, much lower share of vacancy. That gets amplified if you want to have higher quality space, i.e. prime grade space. But we can go more granular than that. And this is where the slide gets really quite, you're gonna have to focus, and I'm so glad to see, A, these screens are so big, and B, that there's so many screens around the room. There's quite a lot going on in this one particular chart. In simple terms, higher level floors in core areas, this is purely for prime grade assets, higher grade floors in core area has a third of the vacancy of lower floors in non-core areas in Sydney CBD. It's about half for Melbourne. So there's a value premium on core, there's a value premium on higher levels. And that value premium is increasing. And what's really interesting is that height used to only be the domain of Sydney. Got the views of the harbour, Harbour Bridge, Opera House, whatever. Even with Melbourne's 19% total vacancy, there is a significant premium on height in Melbourne now, and that's only emerged in the last couple of years. So bringing this bit together, no new supply coming out, massive premium on quality space and higher level floors. If you are out in the market right now for space, I would say you have to be extremely proactive in your approach. And let's see if we just work through this. You want 1,000 square meters in Sydney CBD. You don't really care where it is. Well, fine, that's the bottom level of the funnel. You've got heaps of options. But if you want premium grade, if you want to be in the financial core and you want to be in the top half of a building, your options rapidly dry up. And I'm being told by our local team now that those options are now down to, you can count them on one hand. And this is something that's happening the world over. I talk to all of our corporate tenants, clients, and say, if you are active in the market right now, you have to be incredibly proactive to secure the space that you're looking for. So, where to from here? Now, bit of audience participation now, so I hope everyone's listening carefully. It wouldn't be a presentation in 2026 without talking about AI. And actually, seeing Dr. Claire present earlier, incredibly interesting, because I want to pick up on a few of those threads. As a global research team, we've spent a lot of time over the last 12, 18 months or so, focusing on the impact of AI on the macroeconomy and also on CRE as a whole at the market level. And we've been slowly launching that over the course of this year. We're about to launch some work now specifically for Australia, so you're all getting a preview. And I want to combine this in with our outlook for various markets. Now, if I try and give you a viewpoint for the year ahead, it's probably going to be of 10 years ahead. If I give you a single number, it's undoubtedly going to be wrong. I'm sure we're going to have different views on what AI will or won't do to the economy and what it will or won't do to jobs and therefore to CRE. So on that basis, we took a scenario approach. Now listen carefully, because by show of hands, I'll be asking you to kind of provide your vote here. Scenario one, I like to call this the Goldilocks scenario. So rapid adoption of AI, it boosts output, all that capital that gets generated gets ploughed back into employment, boosts jobs, more money into the economy, more expansion, more CRE demand. Goldilocks, good, 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 good. Scenario two is a bit more tempered. Slower rollout of AI over a longer period of time, more moderate impacts on CRE. Then start to move into the downside scenarios. So we've seen that the equities market is whipsawing. Equities gets very nervous when companies invest too much in AI. They get very nervous when they don't invest enough in AI. There's an overcorrection, which then flows through to the macroeconomy. It's a cyclical downturn, slowdown in CRE demand, but there is recovery over the longer term. And scenario four, dystopian jobs displacement. AI is coming for your job, basically. Large-scale labour reduction, so rapid adoption of AI. It's almost the opposite of scenario one. Rapid adoption of AI, but as a result, AI's job replacement, not job enhancement. Now, I've done this with about 350 people so far, so I'm going to be doubling my sample size in one go, which I'm excited about. So, by show of hands, and we have to do this quickly because I've got 2 minutes 42 here. Right, by show of hands, who likes scenario one? So, Goldilocks. Okay, we've got 3 optimists out there. Brilliant. Okay, who likes scenario two? It's a little bit more tempered, a little bit more reserved. Okay, this is where we're at. Cool, like it. Who's thinking bust? Equities is going to overshoot. Yeah, okay, that's all right. And then who is, no, I'm out of here. AI's coming from my job. Oh, there's only, okay. So we've got 2 or 3 on 1. We've got 2 or 3 on 4. About 25% or so on scenario 3, and the rest of you on 2. To let you into a secret, these are the probabilities that we assign. So that scenario 2 was our baseline approach. Companies will use AI to augment work, first of all, before replacing workers. I I will give you a couple of seconds. If you want to see a preview of this report, if you can zoom in your phone quickly enough on this, I'll give you a couple of seconds. This is launching next week, but it's already available on our website. Freebie for everyone in this room. So what does that actually mean going forwards? So we are optimistic on GDP growth. We think it's going to look relatively solid over the near term. Yes, in that red line, that's the AI bust, cyclical downturn, but it does recover over the longer term. Rather, the orange and the green, that's your upside and displacement scenario, huge productivity gains driving GDP. You see that labour productivity down on the right-hand side, on the bottom left-hand side. But, and this is kind of where the importance of those different scenarios starts to take effect. In that, moving to the bottom right-hand side, if you're one of these upside people and think it's going to be augmenting and supporting jobs, you move to structurally lower unemployment. If you're on the opposite side of the equation, you move to structurally higher unemployment. Okay? And then inevitably, that starts to flow through into CRE markets. So combine that lack of near-term supply, ongoing demand for jobs equals ongoing demand for space. In all scenarios, except for the jobs displacement scenario, you see a downturn in vacancy, which ultimately drives your rental growth going forwards. So near-term takeaway is markets are going to be tight. It's going to be ongoing upward pressure on rents, especially because of that inflationary problem as well. So let's bring this all together and wrap it up, because I'm now at time. So the economy requires a meaningful boost to productivity. Otherwise, it's going to keep hitting the handbrake, and we're going to run into the problems that we did in the first 6 months of this year. It has to happen. As a result, we're seeing a sustained period of lack of new supply. Markets are going to get tighter. Even Melbourne at 19% is going to come down from that high. Premium is definitely going to get tight. Now, we're seeing that tenants are definitely valuing centrality, quality, and height, but it also needs to be married with that excellent the workplace experience, that compelling enough to keep coming back and back and back. AI across industries, and this is what Dr. Claire was saying about, it's going to change dramatically. Behind all of that modelling I've just taken you through, we've gone down to 19 different industry classifications, goodness knows what else. We've done it at the city level as well. The impact on Perth is different to Canberra, different to Sydney under each scenario. Again, all of that's in there. And one thing we didn't really get to touch on today, but with that changing nature of work, the location of offices and the fit-out typologies of offices will also have to change into the future as well. Thank you very much.
Thank you for that. What an informative session. We do have a few questions that have come through to you. First off being, is the lack of commercial office supply actually going to be offset by the reduction in floor space required by organisations due to work from home arrangements and a lower number of office staff due to AI workforce displacement?
Okay, a little bit to unpack there. I think the effects of hybrid working, changing workplace strategy, they've washed through the system now. There's been very little change I've seen in any market anywhere in the world in the last 2-3 years around office attendance. It's pretty much stabilised where it has. So I think that in itself has kind of washed through. On the AI side of things, I think it comes down to which scenario do you believe in. We think that there's going to be job creation. Now, I think the headlines have conditioned us to think about job destruction. And when I first did the straw poll by hand, the majority of people I was speaking to were either AI bust or job displacement. People couldn't see the job creation. In the last 3 to 6 months, I'm hearing about new roles, chief AI strategy officer, these kind of things. So I think there will still be job creation, which will create more demand for space. It's not going to be even demand of all buildings. It's going to be specific locations, specific types. But equally, as the nature of work changes as a result of AI, fit-out typologies are going to have to change as well. And our broad view here is that you're going to end up with more floor space per worker, We've already seen that with the changing workplace strategies in the last 5 years. I think that's going to be a continuing trend, that you're going to be having more spaces for human interaction. You're going to have some, things like secure data rooms, live data streaming rooms, those kinds of things. And so the space is going to look different, but on a per worker basis, I think it's going to end up being more, and that's going to be driving demand going forwards.
Great. Our next one is, if we assault technology year on year that promises to do things more and faster, so on, why does productivity not improve?
Great question. Okay, another quick straw poll, because I love doing this. Who uses AI at least once a week? Cool, that's pretty much everyone. Okay, who here in their company has actually got AI systems embedded at the enterprise level running projects and actual tasks? So this is not you tinkering around looking at your recipe for the weekend and things like this. This is actually doing processes and tasks at the enterprise level. Okay, it's a much, much smaller show of hands. That's the issue. So what we're seeing at the moment is individuals doing more with the tools. I've just got Claude. I'm like a kid in the candy store. Just got Claude. I'm so excited. But it's helping me individually get a little bit better. Our CFO is not seeing that show up on the bottom line. And it's because it's not embedded at the enterprise level yet. So that then comes into pilots, it comes into testings, it comes into governance, just making sure that AI doesn't go rogue, what Dr. Claire was talking about earlier, those kinds of things. That takes time, and that's why we haven't seen that productivity come meaningfully through yet. If you ask me when you think it's going to come through, so 28 to 2030, roughly. We're starting to see it happen in the US, and the US is 12 to 24 months ahead of the rest of the world in this.
Next one's a quick one. Is property still a good investment?
Yes. Next.
Great.
I wouldn't get out of here alive if I said no.
That was too quick for me. Do you think build costs and KPI would still have spiked as much if COVID didn't occur?
That's a really good question. I mean, it's the kind of what-if scenario. Ultimately, yes, because there have been exogenous forces out there as well. Middle East crisis, conflict certainly has not helped the situation. We had an inflationary problem coming into this year. That's only just exacerbated it. Would it be as big? No, I would say. No, it wouldn't be as big as an issue as it is now, but build costs have long been an issue.
Great. And in terms of workplace strategy, what's one of the areas you think we need to move our focus to right now?
Well-being. I think well-being, it's not the silent sleeper, but I don't think it gets enough airtime compared to productivity is the one that everyone wants to boost, and it's almost like the holy grail of measurement. We've got productivity in XSF, but it's a self-reported productivity. Some people scoff at that, and it's like, yeah, well, of course people are going to say they're productive. But at the same time, we've actually seen dips in self-reported productivities. The people are confessing that they themselves are not as productive as they were. So productivity gets a lot of the headlines, but it is inextricably linked to well-being. And so I think you need to be looking at how you enhance well-being in the workplace and in your workplace strategy to actually really have a meaningful impact. And we've done work on this, not specifically on well-being, but around flexibility and productivity and work and office location. If you give an employee flexibility on when and where they work, but then they have a better outcome on well-being and productivity than if you don't. If they then have that flexibility and choose to come into the office, the outperformance goes higher. So it then has to be the onus is on us as CRE professionals of how do we make people want to come into their office. It comes back to that line of how do you make it enticing enough that people want to come in, but compelling enough they want to do it again and again. Because on our findings, that's where you get the boost in well-being, and it flows through to your productivity gains at the end from there.
What impact will uncertainty around long-term headcount needs have on lease terms? And do you think occupiers will agree to a rental premium for more flexibility in the lease terms?
That's a very interesting question. So Australia and India have two of the longest average lease terms in the region. Most of Southeast Asia is 3 years on average. I can see a scenario where tenants are pushing for shorter lease premiums. That's certainly what I'm hearing from our corporate clients. And they're willing to pay more for it. So I would say yes to the second bit, because it's insurance. I've just come back from India. Flex space there is still a huge, huge thing in the market. And so there's a lot of talk around 80% head lease, 20% flex space, things like that. But equally looking at different structures of lease terms. Same in the industrial sector. We haven't even touched on that, but we're seeing that warehousing is going higher and higher, but not necessarily bigger floor plates. Do you move to a cubic square meter rent rather than a square meter rent? So cubic meter rent rather than a square meter rent. I think these things are all up for discussion over the years ahead, but yes and yes on that.
Great. Thank you, Dr. Dom. I think that's all we have time for.
Thank you.
Cheers.